One is they're generally consensus-based organizations rather than voting organizations. They're literal votes, but their decision-making is predominantly consensus-oriented. So what that means is you have to have a consensus, you have to convince the very last person, the slowest moving person.
Which takes time. It's like jury duty.
Exactly. That's exactly right. And then on top of it, you're generally data-driven, and it just functionally takes time for data to emerge,
like you said, there's too many fluctuations in the market on a day-by-day, which is why the longer term.
Exactly. So what they're doing is they're taking lagged data, they need to see a fair amount of it, and then they need to develop a consensus around the policy that they're choosing. And so you put all those things together, and almost structurally, central banks are just slow-moving entities, and particularly in circumstances where there isn't an obvious growth problem, they're generally very slow-moving. Because if you're the Fed, like, really, what is the cost? If unemployment's at 3.8% and has been for the last 18 months and isn't really moving around very much, what is the cost?
You can just go and focus on your second mandate, and you don't really have to do anything else to really mess with it.
There's no reason to move quickly. And I think people too often think, for instance, in that two mandate system, the inflation and the growth, they think that the level of responsiveness to both is the same, and it's not the same. If growth is deteriorating rapidly, the Fed will cut interest rates rapidly.
Okay,
But if if inflation is moving towards their mandate, that's great, but there's no urgency to cut interest rates.
So the only reason that inflation is on the front burner is because of how severe the current circumstances. Otherwise, growth and employment would be their number one priority.
Is the sort of thing that causes them to act with urgency.
Gotcha.
Right? When the financial crisis was happening, no one was sitting around going, wow, look at the inertia of the central bank. Ben Bernanke was like writing a new policy every single day.
Yeah.
You know what I mean? They were moving.
15% unemployment will get anybody moving.
Will get anyone to move.
Yeah.
And so I think
that's when the pitchforks come out.
Exactly. So I think but if there isn't any movement on unemployment, the economy's fine. There is no urgency to move, particularly in the cutting direction. I think it's mostly what we're seeing, whether it's with the Fed, but also what we're seeing even in Europe, which has technically an inflation mandate. They too aren't likely going to move all that fast because the economy in Europe, is like generally not fantastic, but it's also not deteriorating rapidly. Right. If it started to deteriorate rapidly, then they would start to move more swiftly to respond to that.
Yeah, I think just America has the U.S. economy specifically had such a rapid growth that relative to the peak, it kind of seems like we're regressing, whereas other countries maybe haven't even had that big of an expansion. So it looks like they're more stable.
Yeah. Yeah. I think part of the thing is
we have two last questions after this.
Yeah.
Too long.
No worries.
I'm having too much fun with this.
I know. I'm
taking entry
this
there.
This is the stuff that I enjoy. So. I can do this all day. I think part of the story there also is I think a lot of folks who've been in the markets for a long time, they sort of remember, what was the sort of 3-4% growth rates, real growth rates in the U.S. back in the 90s. That was good. But, the U.S. economy has changed just, from a demographic perspective. You have much lower labor force growth today than you had back in the 90s. From a productivity standpoint, in general, structural productivity is lower today than it was back in the 90s. And so kind of like today's 1 to 2% real growth is the 90s, 3 to 4% real growth. And that's a thing that, so and to be clear, in the European context, which has a way worse demographic story and a way worse productivity story, actually kind of zero growth in those economies.
Wow.
Is actually, is keeping, for instance, unemployment at secular lows.
Yeah.
And then you go to a place like Japan and it's even worse than that. There's some reasons to believe that actually negative growth in Japan is actually still enough to keep, you get modestly negative growth in Japan and keep labor markets tight and keep the economy kind of, the employment in the economy pretty good. So you do have to have that perspective. And so kind of what feels like a little soft today is actually still likely enough to keep labor markets tight, which is what we're seeing.
My biggest takeaway every time I talk to you is the relative nature of data.
That's
all right. Welcome back, everybody. So NFP Friday, first Friday of every month, we have the farm payroll numbers, the amount of new jobs that were added to the economy, and just the overall unemployment rate, the amount of people that are currently working versus the amount of people that could or should be working. So it's the total population of able and willing people, and then the people that are actively participating in the workforce. That number has been getting a worse and worse. We had a 4.2% print this morning, which is higher than expected. We were expecting 4.1, which is not good. I think this employment situation is it's not worrying markets because Trump is typically seen as productive for the labor market in terms of bringing jobs back to the states, especially manufacturing, opening up energy jobs back in the states versus some of the regulations that were kind of hurting the energy industry in the United States. So I think Trump is seen as typically more productive. That's why we're seeing positive market reaction. Still early in the day, we might see a big sort of downswing later, just initial reactions to this negative headline. But overall, I don't think this is going to panic the markets in any way, shape, or form. I think that the market is preparing for a positive Trump economy compared, if you just compare it to the last economy, how productive it was in terms of bringing jobs back by incentivizing corporations through tariffs and taxes to bring jobs back to the states. And yeah, so that's why negative headline. It's going to be maybe a minor negative reaction, but overall, this is not going to move the markets in a negative way at all. I think this is, if anything, might give everyone an opportunity to get in at a good price today if we see a big retracement back to the Tokyo session lows. So if you guys just give me about 5-10 minutes, we'll go through some re-entry opportunities. I'm playing this interview I did with Bob Elliott, senior economist, just talking about all markets, and I think it's still relevant. This was only a few months ago, so let me know if you guys have any thoughts about what Bob is saying. Also, here's the receipts. If you guys were on the live streams yesterday, there was 2 trades that we were looking at. The first trade was this buy all the way up to 21,500. The entry was 21,466. Okay. Sorry guys, just getting spam called this morning. What? All right, let me see if I can just pull this up right here. Beautiful. Let's do a side by side. Oh wait, wrong one. So this is from the live streams yesterday. You guys can see there was 2 trade opportunities that we were looking at. There was the first one, and then the market ended up breaking to the downside. We had another entry at 21,423. Let's see that first trade reached all the way up to 21,536. That was a beautiful trade. And then there was that false break to the downside. First trade hit SL. And then there was a re-entry opportunity back inside the range, and then re-entry 1. And this morning was really quick. I was actually in a short this morning. First trade I took. I know I don't typically short. I know. But the trade was too obvious here. Where are we at? Okay. Really, I think this was like, I was expecting probably 15-30 minutes pre-market open. Market was trading inside the Tokyo session range. We had hit the top. Beautiful kind of head and shoulders formation, 88.6. I was expecting a nice 2.5 to 1 R on this trade. But I had take profits where I had the sort of closing the contracts here at 38 fib instead of the full TP. As soon as the news broke, market smashed all the way through, hit the bottom of the range, and then took off without me. All right, so we'll look at some re-entry opportunities here. Overall, I think this was a pretty good trade.
It's like, because when the big conversation we had the first time was about the relative nature of currencies.
Yeah.
And you told me that currency valuations are not to be based on a standalone nominal basis. It's relative to the performance of other currencies.
Right.
That changed the game for me because you could look at an environment which should be, let's say, bearish for the dollar, but you can see like the DXY going bullish because relative to the performance of other central banks' policies at that moment, America was still, or the dollar was more attractive.
Exactly.
Relativity is a huge. Two questions. This is going to be a boring one for the phone, and then I'll ask you a fun one, which is where you see the markets going. That'll be the last question. But you mentioned bonds, and so we have to talk about everyone's favorite topic. What do you think the bond market pressures are today? Do you still see any structural problems with regional banks holding these kind of mixed duration assets? Do you see any structural problems in the bond market? Specifically as it relates to pension funds holding them in small regional banks.
Yeah, I think the bond market story, if you've been through a few cycles of, let's call it the regulatory freak out, which is basically what we had, which is regulators got totally caught off sides with the SVB thing, not actually ensuring that the banks were in good shape. This is how it always works. There's a spark. They totally miss the boat initially. And then what they do is they go to they stabilize conditions, which is exactly what they did with their policies there. And then they go into every single bank. When I say they go into, I mean, there's literally a person who knocks on the front door of the office of every single bank, walks in and says, open up the books. This bond problem, this duration problem is a problem. I want to see exactly what the problem is. And I want you to ameliorate the problem by dealing with it, whether it's selling the bonds or putting on swaps or dealing with it.
That's got to be fun.
And so I think people are today's bank problem when it comes to duration is totally different than it was before the regulators were aware of the situation. And so I think if you look at the banks, it's been a very interesting period here. We've had 60 basis point rise in interest rates over the course of the year, and we've basically seen flat performance in KRE, maybe up a little bit, but flat performance in KRE. If there really was a big bond sensitivity from these banks, you'd expect to see some real deterioration as interest rates rose. The real only problem bank that we've seen so far through the course of the year, New York Community Bank, is related to related to specific housing stuff that's going on in the New York City metropolitan area. There's nothing globally indicative,
of course,
of what's going on with rent controlled housing in the Bronx, right? Like that's not a thing.
There are certain pockets where those regional banks have the same risk exposure. Say San Francisco and New York being the two biggest. And the issue is that a lot of the commercial real estate loans are not being marked to market because of obviously everybody's moved out of San Francisco. Commercial real estate took a hit. So you think like if they were to be marked to market, that they would have to they would have to call those loans. They would have to get the loans would get margin called. Is there any of these independent sort of risks that could lead to a bigger issue, even though they're not all intertwined?
Yeah, well, I think take CRE as an example. Most of that's on balance sheet lending. Yeah, and the thing you have to understand with banks, the thing that banks are really good at is lying about the quality of their assets, and it's almost a system explicitly designed to lie about the quality of your assets if they're on balance sheet loans. And so just as a simple example, since the CRE thing blew up, whatever, first quarter last year, banks have accumulated $60 billion in NIM, in incremental income from those loans. And they booked $600 million of losses. So 1% of the total income that they've earned, they booked in losses. And the reason why they can do that is because they don't have to mark to market those assets. And so what's going to happen with CRE is we're going to be long. The CRE problem, which is a real problem. The loans, some of those loans are undervalued, are underwater, and certainly the equity holders in the CRE are going to get hit. But by the time that gets recognized, it's going to be 5 or 10 years from now. And so banks will have had plenty of time to earn out in terms of their income on an ongoing basis. And frankly, we'll be on to this thing or that thing or the next thing related to the banks. There could be plenty of problems in the financial system. The banks are not going to be the problem. And I know that's a dangerous thing to say. Yeah. Anytime someone is like, you know what, there will not be a problem. That's a red flag. That's a very dangerous place for a macro person to say, because you can always say, well, there might be a problem.
Yes.
But I think the banking institution is a place. Take it from someone who thought that there were going to be trillions of dollars of losses in the U.S. banking system years ahead of the actual financial crisis, and got that spot on. I understand the bank system today, and there will not be trillions of dollars of losses in the banking system. It will not be the problem. There may be other problems that emerge, but it's not in the banks.
And there's nobody better to speak on it. So I really appreciate that breakdown. So, and I really do appreciate the nuance here, because it is hard to parse through all the data to see how big of a systemic issue is this going to be. Do you see any issue? So you're saying that 4 to 5 years is when they're actually going to have to mark to market.
Well,
the issue with the bonds is that they had to realize the losses today, and that there was a sort of a bank run that happened as a result. That's always a risk, isn't it?
All right, so we just hit the 88.6 on the top side of the range. Let's see if we get this pullback. So two options here. Pullback 88.6. So we're going to see a correction here. It's going to play around the zone and then wick aggressively back down, give us a correction. And then if we're lucky, it comes all the way back down to the bottom of this range, 21,460. Option number two is if it doesn't give us a big rejection, it just sort of minor rejection, plays around this area, and then just continues to break. Then we look for the Model 1 continuation. So break back inside the range is going to come back in to the previous resistance. A lot of kind of, let's say, beginner traders probably load up positions here. And then what will happen is a break back inside the range, liquidate most of the buy positions. Once there's a lot of sell interest, then we see continuation back up. All right, so we're probably getting that second, not even probably. This thing is already starting to break those highs, approaching all-time highs here. Okay. So in that case, break of the high, wait for this thing to hit the extension level, and just wait for a correction back inside the range. Quick fib from top to bottom right here. That would put us one second. It'd be about 21,470, but it's not a very impressive zone. There's really nothing here. I'd much rather see that inverted head and shoulders retest, support, support, support. Much rather get this correction, but it's about 10 points of a difference. If you're not using crazy size, I think you'll be all right. So what I'll do is probably put a tester entry here, and then if it does continue to correct, I'll probably close out of that trade and then enter 2, maybe 3 times that position right here. So put a smaller one at that 61 fib, and then if it does correct lower, obviously have some ammo on the sidelines. Sheesh. Wow. All right, just hit the extension level. Quick pit stop, but something's telling me that we're probably not going to get this correction here. This thing is probably just going to keep pushing through. Still early in the session, 17 minutes into the New York session. So in the next probably hour and a half, we could see a correction back down. Never chase markets. Never try to guess the top. This is why, even though we were making jokes this morning about shorting, that was a pretty dangerous move. If you saw that whipsaw, I'm very glad I had take profits set, because that'd have been pretty rough, right? So shorting against this market, horrible idea, or shorting against any bullish market, honestly. You can grab great moves. You can make a lot of money on the short side, but betting in the direction of the market and buying at discounted areas is always going to give you a better chance at winning. Just by default, you're on the right side of the market and you're buying at discounted prices. Right. So for this, I'm not looking to short, looking to wait for a correction to one of these key areas. And if we don't get that correction, rinse, repeat, come back tomorrow or Monday. Cool.
Well, from the securities portfolio, this is the difference between on-balance sheet lending and securities. And
Okay.
securities, if they're booked as available for sale. So within securities, there's available for sale and held to maturity. Held to maturity doesn't have to be booked. Available for sale does have
okay.
to be booked. And so this is, what is a bank? A bank is an accounting scheme. Right, that's what a bank is, right? Where you earn income today and you only talk about how the assets are evolving when the actual cash flows get impaired, right?
Yeah,
That's
yeah,
what
Yeah,
a bank
this man Bob
Yeah.
is funny. as
right?
shit.
And it's a beautiful thing. It's a beautiful thing because it creates an infrastructure. There's a stability of the accounting on misrepresentations, not
Yeah.
illegal misrepresentations, but the fact that you don't have to mark to market. There's a benefit of not having
Of
to
course,
mark.
you're valuing everything at the best possible scenario.
Exactly, until it doesn't actually get paid.
Just
right?
like you said about equities, which is that the valuation of all these things right now is very high. Now, if the reality does not meet the expectations, and if they do not at maturity or at the time of, like, let's say Tesla or Nvidia, if in the next 6 to 12 months they don't hit those performance metrics, that's when the
That's
issues
when it
start,
gets realized.
when you realize it.
And the beautiful thing about a loan is you don't really have to recognize it until either someone stops paying, which is pretty unusual, because in general, people have plenty of cash flow to pay like the marginal interest on a loan.
Yeah.
So then it's really when the loan comes due. And then at that point, what happens is the banker is shocked that the person can't come up with, wow, I am shocked you don't have the money. Of course they don't.
Yes,
They
of course.
didn't have the money for years, right? But they don't have to recognize it. And even then what they do is they say, well, we'll extend it, we'll restructure it, bankers are much better at dealing with the bad loans that they've made than they are making good loans. But that's the nature of the system.
Managing downside.
That's the nature of the system, is that they manage that process very effectively. And all the regulators, they're looking to the side saying, yeah, of course, you're doing it in the right way in order to limit financial risk. And so a big part of the story has been, it's not the whole book. It's not the loan book. It's not in many ways the available for sale, the held to maturity bonds, because those get marked when, through time, once they actually mature. It's really a small portion of the overall portfolio. And then what's happened is the regulators have come in and basically said, take duration risk off the table.
Okay.
And banks can basically do that. They're essentially booking a loss.
Yes.
In the sense of, like, the bonds, the value of the bonds or the income that they're going to receive is likely to be lower than the income, than what they might have to pay on the liability side.
Look at this beauty. Phase 1. Phase 2. 886 retest. And launch. Maybe continuation model 1. Or continuation model 2. Or both. Like yesterday, we had both moves play out. Could we see both continuation model 1 and 2? Oof. Or this thing just keeps flying and we never see it again. We're already at all-time highs. We might hit 22,000 next week, Christmas rally style. So are we going to get a correction during New York? Probably. Everything corrects, people. So markets can't move in a straight line. Well, I mean, if you look at it this way, they can for a short amount of time, but give it another 30, 45 minutes. I'm confident that we'll see a correction. It'll be pretty aggressive. The faster the market moves in one direction, the faster it'll correct back down. Equity markets always move down in a more aggressive and a more rapid pace than they do to the upside. And so if you guys see a move like this, right, which is like just defying gravity, it's like falling upwards, then the correction is going to be even more intense. So that's why I said, don't try to guess the top, because what it does is at every resistance level, it just tries to collect as many people who are trying to short as possible, and then it smashes to the next level, and then the next level, and the next level. And once there's no more short sellers, then the market will correct aggressively back down. Once a lot of people start to be late sellers into the market, then you'll see a continuation of the trend. So think like, just think rationally, buy at discounts, sell at premiums, don't chase. And what goes up must come down.
But we could lock in that circumstance and basically say we won't
Eliminate a catastrophe.
we won't have a catastrophe
Yeah.
because we've put in hedges. And you see that you probably don't sit around reading regional bank,
Little do you know, Bob.
investor presentations. But for those nerds who do, you can start to see, they're reporting their interest rate sensitivity. Their
Bob
book is
don't know
starting
me.
to come down. It's not that high.
That's
And
good.
so those sorts of risks, I think, are starting to get meaningfully mitigated. And you're seeing that in the price action, which is interest rates are going up. Even when interest rates were at 5%, which you'd expect if there really was a bond problem in the banking system, you would have expected with interest rates at 5% last year
Yeah.
to see a bunch of banks blow up.
Yep.
Crickets.
But is that because the bank term funding program came in and sort of created a backstop for any of the regional bank failures, or without the BTFP, it still wouldn't have been a
I think
systemic
the
issue?
BTFP ended up being like 0.1% of overall assets in the banking system. It wasn't really the big story.
I just think it was significant in terms of the amount of liquidity put in, because if you look at the quantitative tightening facility, they were trying to remove what it was, 100 billion a month, and then that for 6 months they had removed close to half a trillion, and then in the span of 3 or 4 weeks after SVB, they had pumped back in close to 150 billion dollars and sort of undone a lot of the liquidity sort of tightening that they were trying to do. Do you think?
Just on that point that I was asking Bob, basically like after COVID, we had an inflation problem. Joe Biden took over. Bidenomics was basically the art, the sweet science of pumping trillions of dollars into the economy when inflation's at 6% already. And then they ended up driving inflation up to like 9.2%. So the goal for quantitative tightening was to remove $100 billion a month. Give me 1 second. All right, so $100 billion a month. And then in 5 months, they ended up taking out about $500 billion total. Okay, which seems like a lot of money, but when you pump 14 to 17 trillion dollars into the economy, this is nothing. Then when the banks started collapsing, the ones that were heavily leveraged with debt, and then servicing some pretty, I would say, volatile companies like crypto companies and the rest, they ended up having to go to the Treasury and start this facility called the Bank Term Funding Program, which was a lending facility to help banks like Silicon Valley Bank and what was the other one? I'm spacing on the names, but you guys might have remembered those stories where those banks started collapsing and the Fed or the Treasury had to step in. And they basically undid that entire $500 billion that they tried to take out of the economy. They undid that in about 3 weeks. And so I was like, we didn't really pump any money out of the economy during this whole process. All we did was raise the interest rates, really slow down all activity. And I guess that sort of brought inflation down. But if we all are honest, like all the stuff that we pay for on a regular basis, I always used haircuts as an example. That's a pretty good metric. Like none of that stuff is going to come down. So there's sticky inflation, stuff that is just going to stay high because once people pay a premium for something, the servicer is usually not going to go back to charging that low price. So we're kind of in that situation now, where we have that sticky inflation with all the stuff that we actually spend money on. But then they're trying to basically say that because gas prices are coming down and maybe home prices are starting to come down a bit, that overall inflation is starting to reduce. Long story short, we didn't take enough money out of the system. All we tried to do was slow things down and break the economy. And guess what? It worked. Unemployment's at 4.2%. All right, let's take a quick look at this survey here before we go back to the podcast, because today was NFP. We'll go through the employment report here. Job gains, healthcare saw a job gain of 54,000 on a month-by-month basis. Leisure, hospitality, another 53,000 jobs added. Government, big surprise, government's still growing. Doge is on the way in. Expect to start seeing negative numbers in this category here. Social assistance, 19,000 new jobs. Transportation equipment manufacturing, 32,000 due to the end of strikes. Wow. That's way bigger than you'll normally see in a sector like transportation. Job losses. So retail trade, this actually, I think is going to turn back around. Seasonal jobs, like people who are working for the holidays, they might work for a month or 2 months while they're back on break. You're going to see a lot of that seasonality play into the numbers next time. So this is not too concerning. General merch, 15,000. Also, not sure what this is about. Gains in electronic and appliances. That makes sense. People probably shopping online for other merchandise and then maybe electronics and appliance sales. I mean, hey, can't read too much into one report. Let's look at demographic surveys here. So Black unemployment rose slightly to 6.4%. Other groups, white, Asians, Hispanics, adult women, and men showed little to no change. Okay. Long-term unemployment, 1.7 million, 23% of all unemployed. Up from 1.2 million a year ago. Wow. So folks who are long-term unemployed, steady at 62.5% with unemployment. So labor force participation, very low. This is the percentage of the overall population, the civilian, non-institutional population, meaning not government or military, civilian population. We're operating at 62% capacity. We're slacking, people. We got to get more people in the game with an employment population ratio of less than 60%. So less than 60% of our overall population, I think there's like 310 million people in the United States total. Only 60% is in the game working. So this also includes children, adults, folks who are disabled, all that stuff. Not good. The reason that this is important is like if you have like the bigger that the percentage of your population is that's not working, the bigger the strain is on that percentage of the population that is. Because someone's got to take care of the rest of the people, right? Through entitlement benefits and the rest. This is the problem that China is seeing. China thought it was a good idea to have a one-child policy. So now they have this aging population that needs taken care of, and they don't have enough young people to take care of them. So that's why China, I think, is going to have a very rough time, kind of the next 6 years. And the next 6 years is really my timeline for how I'm seeing this thing play out. Kind of the new era of markets, the new era of global dominance, the new era of technology trends. Between now and 2030, I do think the US is going to have its shit figured out as long as uh, really this new presidency can deliver on all this stuff they said they would. But I think China's going to have the opposite situation. I think they're going to have a pretty rough next 6 years. The demographic thing is really tough to beat. Japan is dealing with it right now. You have declining populations almost everywhere in the world. And if it wasn't for the massive immigration problem in America, uh, America's basically just gliding by in terms of population decline or growth. We're just sort of flat. But that's because of the massive immigration. Obviously, the best way to solve that problem is to have more babies in your country, to stop the population decline, to really have a thriving next generation and a thriving generation after that. But despite what everyone's saying, there's a population decline almost everywhere. These demographics put a lot of strain on the GDP of that country. If half your money is going to entitlement benefits like Canada, and just going straight to taxes and all of it's just going getting paid out, at some point you're going to be like, well, why would I work harder? Why would I go and achieve more if the more I make, the more they take? And so I think that that's just a negative direction to go in. Demographic decline, I think, is going to be a big topic. Inflation was the topic of the last 4 years. I think that demographics is going to play in the next 4 to 6 for sure. It's going to be the AI revolution, really who integrates faster, because the sooner that you start to implement AI as a country into decision making, into functionality, you start to reduce costs, especially in the government, and then use technology instead and things like that, you're really going to have an advantage. Every month counts. And so you add up a whole year, 12 months of, um, implementing this new technology versus all these other countries that aren't, you're going to have an advantage that people just can't catch up. And developing countries are going to be at a massive disadvantage. But even like we're talking about global superpowers, let's say like Russia, India, China, everyone's fighting for this quantum computing, implementing AI, implementing technology into their ecosystem. But I do think that America's capitalistic structure has that unique advantage, right? Where you could implement all you want in China, this AI technology. All it's going to do is add more layers of complexity, more layers of regulation, and slow down the entire process. I think in America, if all the small businesses and all these big companies are using this new emerging technology, they're just going to be 10 times more productive overnight. And I think that we're going to be entering really a new revolution. We had the Industrial Revolution, early 1900s or late 1800s. We had we really had like a new technology revolution with leisure time in America. That's kind of like the pivot point where a lot of the stuff that used to take all day got taken care of. So the invention of the washer and the vacuum, like all these things used to take literally 16, 18 hours a day to do. So the invention of leisure time was really kind of a new revolution. So that was kind of a new industrial revolution. The sec or Then we had the technology revolution of the late 1990s, early 2000s with the tech boom and bust. That really started most of the companies that are the behemoths today. So between then and the '08 crisis, that's where you had all the major companies like Tesla, Amazon, Google, all the leaders really hit their mark and really start to develop. And then people kind of thought that this was the decline of the US. The truth is that the distance between each revolution is getting shorter and shorter, and it's getting more and more impactful exponentially. So I do think this new technology revolution here, probably in the next 6 years, we're going to really see the foundation set. Um, I think this is going to be bigger than anything in America's history. I really don't want to like overstate that, but you guys see that Bitcoin hitting a couple trillion in market cap over, the span of 10 years, where there's assets that have been around for 100 years that still don't have that market cap. There's, companies like Nvidia that hit $2 trillion in market cap. And then you have companies like Coca-Cola that have been around for 100 years or whatever it is, and they still haven't hit that market cap. So the time and the scale of what we're dealing with here just really can't be understood, especially past 5 years. But I do think America's at a massive, massive advantage. Okay, so just want to put that in the backdrop. That's the sort of playbook that I'm looking at here. Is global dominance depends on who's adapting faster with these technologies and helping their population use this stuff to their advantage. And I think if you have economies that are overly regulated and overly censored and overly authoritarian and overly, socialist or communist in nature, they're not going to be the big players. That's why I'm not worried about the China kind of duopoly thing. I think America's going to dog this out, and it's going to be such a big revolution and such a big boost to GDP. I think we stay ahead for a while. I think we could really, really be ahead for the next 20, 30, 50 years if we play this right. What do you guys think?
Thing that has an effect, or is it different because they're loans and they're not?
Yeah, I mean, it's a very short duration, 1 year duration lending on securities. So I mean, BTFP wasn't the bigger story around the BTFP thing was not the actual functional liquidity that was provided by the BTFP. It was the regulators basically saying the financial system will not go down as a function of this problem.
So not just the systemically important banks, but even the regional.
Right, exactly. They said, look, I mean, basically what they said is like, your bank, meaning, the bank you have a deposit in, it may have a problem, but we're going to deal with it. And so depositors, don't get concerned. It'll be fine. We'll deal with it. And then that's the whole point of what the regulators are trying to do in that circumstance is to just slow the snowball effect. They're basically trying to freeze everything to say, all depositors don't stress, everything will be fine. And then what they do is they take that time to go into the banks and deal with the problem, right? And to, reduce the interest rate sensitivity and, clean up some bad, some of the banks that are in worse shape, they try and merge with banks that are in better shape. And so that's kind of the process, is just kind of freeze and deal with over time.
So stop the bleeding first, and then basically, because the panic is what can cause a real.
The panic is the problem.
Is that with all Fed policy? Is that kind of what you said? Which is they want to stop the panic first, what could lead to like a lot of unemployment and corporations panicking and things like that?
I think when it comes to financial stability concerns,
Yes.
The biggest lesson in the financial crisis was go overboard on stopping the panic. Because the second and third order consequences, once the panic starts to spiral, then your problem gets a lot bigger.
Yeah.
So if you can come in and basically say, there will be no panic, which is what they did in SVB on that Sunday night. They said, there will be no panic. So we're going to make the, depositors whole. And I mean, they didn't say this explicitly, but like, if you're in some other regional bank and you find yourselves in this circumstance, we are not going to cause you to take losses as a depositor. And what ended up happening? Like nothing. Like people didn't do anything because there was no risk. And that meant that the problem, that's the funny thing about when you talk about these sort of financial stability issues, which is the promise of doing something, then means they actually have to do a lot less than if they didn't promise to do something.
Because the market will front run that decision and be more aggressive in their response than the actual action itself.
Right, exactly.
That's crazy.
Exactly. So that's
so let's talk about sustainability, because these are the last two questions I have, which is obviously this kicking the can down the road and bailout economy that we've been in since the great financial crisis is clearly unsustainable, because as we're locking in this deficit and we're going to have to really deal with what I think is the biggest issue of our generation, which is I think something like the government debt is either the deficit or the debt is growing $1 trillion every 100 days or something.
the total outstanding debt. Yeah.
And so when we're talking about the inflation problem, and then we continue to exacerbate the amount of liquidity in the system, there's really no meaningful attempt to reduce spending, to reduce the amount of overall, I want to say activity, but to really reduce activity so we can slow it down. There has to be an end game here where the train hits the wall. Do you see a way out of these different crises?
Well, I think what I'd say is that there's the fiscal position of the U.S. government is running deficits at a level that over time is likely not going to continue to be sustainable. I think one of the challenges is I can say that and lots of other people can say that. And it's a pretty useless thing when it comes to trading markets because, the deficit, the government debt stock might be unsustainable, but like when does it actually influence the market dynamics? Like
I'm more concerned about the real economy. The real economic impact of, let's say, they're going to have to compensate in either creating more revenue for the government in terms of raising the tax rate in America, or just reducing spending, which, as we know anything about the government, that's a lot less likely. And so if that's an inevitability, are we headed into an environment where we inevitably have to have, let's say, 80s or 90s level tax rates to compensate for the rising cost of servicing the debt?
I think Japan is it's an instructive example here that highlights the fact that when you have large deficits and a significant debt stock, there are levers available that the Fed and the Treasury can pull in order to make the adjustment burden not so extreme so as to meaningfully impair the real economy. And so as an example, like the debt stock, the Japanese government debt stock is, the largest in the world. But the reason why that is possible is that the BOJ has bought a huge portion of the bonds. And you'd say, okay, at what cost? Well, the answer is actually not at that much of a cost.
Except for to the yen.
I would argue that the yen has mostly been weakening as a function of easier monetary policy. The weakening of the yen has been a good weakening of the yen in the sense of it has been a controlled depreciation of the yen to get it more in line with, to get Japanese production basically more in line and cost competitive with the rest of lower cost Asia. And so it's not really like the yen has gone down, but it's not a function of the printing of money to fill the gap.
It's more of the sacrificing the currency to prop up the bond market situation.
That's right. That's right.
But sacrificing the currency also has its own issues, especially with demographic issues like.
But like, why is it so bad in Japan? Like I think that the Japanese solution, if anything, the solution, the story that we've learned in Japan over the last 30 years, is that they didn't print enough money, right? Because
this is why I love talking to you. The contrarian views here are. I'm loving this. Yes.
And so the path that's going to happen. We've got too much government debt. That's absolutely true. So what's going to happen is we're going to print a bunch of money, and we're going to take the central bank, the Fed, is going to take all of that debt essentially out of the hands of the private sector, so that we don't have to raise taxes, in a way that is intolerable on the real economy, and so that we don't have to cut spending in a way that's intolerable on the real economy. And that's going to be the challenge, policymakers' challenge over the next 20 or 30 years is going to be, how do we restructure the US debt stock in a way that is not too painful, not undesirably painful for the real economy, but not so stimulative that it creates intolerable inflationary dynamics. And that's a solvable problem. That's an absolutely solvable problem. It's been solved before. It was solved in post-war periods. It was, there's lots of different things you can have. You can incentivize banks to hold the bonds. You can incentivize, you can just say the yield curve is a certain way. That's just, essentially the Japanese did that to some extent. You can print money to buy the bonds. This is a solvable problem. The thing that I'd say is, and it's solvable in the context of lots of other places in the world are dealing with large debt stocks. And so when you think about the dollar.
All right. So look, is the market going to come back? No. So just to kind of put a button on this, why is the market absolutely smashing when we had a worse than expected unemployment report? Well, I think that I'm not really sure why there's a lot of this, like where a lot of this job loss is coming from, especially in the service industry right before the holidays, excuse me. But it seems like, here's the sector trends. Healthcare saw employment gains, hospitals and facilities saw employment gains, growth in food services as well. State governments growing, transportation equipment, manufacturing, that grew, but that's obviously that was related to the strikes as well. Wages, average hourly earnings rose by 13 cents, up to $35.61. That's the average hourly earnings in the United States, taking all things into consideration, up 4% year over year. So that's good. So inflation is, I think it's growing at less than 3.5% now. And so the whole goal was to get wage inflation to catch up with inflation. So if prices at the grocery store are going up, but your salary is going up faster than the price at the grocery store, everything's fine. But wage inflation typically lags real inflation. So now what we're seeing is that prices are starting to come down, wages are going up, and it's starting to even itself out. Now, you might not feel this personally, and that, I think, is the important piece. It's like, on average, yeah, it might be up 4% from last year, but I don't feel 4% richer. And so I think that the real relief to the economy is going to come from productivity, not really from just wage inflation. The average work week for private employees edged up to 34.3 hours. Are people working 34 hours a week? What the fuck are we doing? This is madness. No wonder we're falling behind. 34 hours. I might work 34 hours a day. I might find 10 extra hours. Get it done. All right. So yeah, long story short, the reason the market is pumping is because confidence in the Trump economy. Two, bring productivity, jobs, manufacturing, and open up some of those overregulated sectors like energy is going to have a massive boost. It's going to have a massive impact on the economy, boost the real productivity growth that we're looking for. And that's why markets aren't spooked. All right. So expect this rally to continue. What do we do with a market that's moving this aggressively? You don't chase. First off, a lot of people on the smaller time frames trying to catch a continuation. The higher it goes, the closer you're getting to the correction. So please don't chase. And then don't try to guess tops. You're going to try to short at each extension level or each fib level. You're going to get a temporary pause like we've been seeing at each one of these levels, and then it's going to smash through until there's nothing left. So make sure you guys are being smart. Wait for it. The market will typically slow down, okay, and then start to range, and then basically just reset. And the reset's probably going to retest the bottom of that range that's created. We'll be able to trade this on probably Sunday or Monday, probably not Sunday. Let's call this Monday, and then let the show continue. If we're lucky, we get a deep correction because that just tells us that we're going to have a more sustained continuation. This is like 2021, people. 2021 looked exactly like this. Every day, market would just wake up and the market would pump, pump, pump. And learning how to navigate in these markets, finding ranges. I took a short in this range. I was looking for the longs, but it happened way too quick. Just being smart, understanding where you are in the bigger picture, and then using the smaller time frame to find proper risk and reward entries. I also want to leave you guys with a quick tip here. I'm just going to do this real quick. If you guys have taken the NASDAQ course, we went through this, but I'll just go give you an example here. So there's a lot of people are always kind of trying to rank technicals, fundamentals, and psychology as like the three things that you need to have to be successful. Some people say it's all about technicals. They don't use fundamentals at all. A lot of people are fundamentals only traders or whatever. I would say that the most underrated piece here is actually the risk management piece. It's the risk management and like the actual risk management analysis. So I'll give you guys a few tips here that are going to be way more valuable than the technical strategy. If you have a great technical strategy, like the NASDAQ one that we trade, it's just going to be that much more effective. But if you don't have the foundational risk management principles and like the analysis done, you're cooked. So let me give you guys a few tips. You guys have already heard me say cut your losses in half after each additional loss. That I think is a great move. Let me give you guys a tip to protect your wins. Okay, so this morning, I'm up 1,700 on each account, have them linked, and I want to take the next trade. So I've had different phases of making mistakes. And the mistakes I would make of giving the profits back is first, I would give back way more than I made, probably below the account. So I'd be up and then I'd end up blowing the account by the end of the week or something. The next phase after that, after years of, or probably a year and a half of doing that, you get to the point where you basically blow it back to break even. And then you give back some of the money, but you get to keep some of it. And you still have to end the week asking yourself why you didn't end the week with 5,000 profits, why you only took home 1,500. Even though you were profitable, you should have been way more profitable, and it was one or two small mistakes. So where I landed on is after each additional winner, you cut your risk not in half, but by like 80%. Okay. So up 1,700. So the next trade that I would take today, if I was to take a trade, everyone says, oh, just walk away. God, in an ideal universe, yeah, you take the trades, you walk away. It's literally that simple. Nobody wakes up and says, oh, I'm going to overtrade today. No one wakes up and says, oh, I'm going to take, a few extra trades. You wake up telling yourself, I'm going to trade today, follow my rules. Next thing you know, you took a few too many, and now you have to deal with the consequences. So if that is going to happen, okay, and you're going to work on that over time, and the more experience you get, the more experience we get, the less we're going to make those mistakes. But it's, if it's a reality, cut your risk by 80%. So if I'm going to risk, let's say either a percentage of these profits, so let's say 20% of these profits would be 1,750 times 0.2, it's $350. So on the next trade, I can risk $350. Or if I usually risk, let's say $1,000 on a trade, 1%, what I would do is I would cut that down to $200. So 20% of my usual risk size for my account. So if it's normally $1,000, 1%, you would cut it down to 0.2%. All right. If you normally risk 0.5% per trade, you would cut it down to 0.1%. So $100. Cool. This one allows you to kind of keep track of the profits you're making and protect your downside no matter what. So you have $1,750 profit for the day on the account. Then you risk 350. Let's say that you lose the trade. You still got $1,400. Wait, is that correct? No, $1,300. No, 1,400. Okay, so you have $1,400 in the account. Now, if I wanted to take a third trade, which at this point you should probably walk away, but if you're going to take a third trade, cut that risk in half. Okay, let's do this down to 175. So now if I lose, why do I keep doing this? 1,300, let's call it 1,225, I think. Let's assume that's correct. Okay, 1,225. All right, so you still get to end with 1,225, even if you lose those two trades back to back. Makes sense? So you want to trade up big, risk a percentage of it, no big deal. Cut that risk down in half. You still get to walk away with this. Now, imagine you just do something like keep risking $1,000. So if I lost both of these trades, now I'm negative 250. Now I'm down. So you can't just keep your risk consistent. You keep blowing the account down to where it's supposed to be, or down to below where you were at. The other option is cutting just risking the profits only. Like, well, I'm not going to risk 1,000. I'll just whatever 750 is, I'll split that between two trades. Now, if you lose, you're back at break even. So you can't do that either. Put a 1 in the chat if that makes sense. We talked about protecting your downside losses and how to basically avoid blowing an account by protecting the downside. Let me know what you guys think about this tip for protecting your gains. Cut the risk 80%, or you can just take a percentage of the profits. All right, let's say 20% of your overall profits and risk that on the trades. So if you're risking 20% of the profits, you can take 5 trades before you lose it all. Okay, if you're risking 10% of your profits, you got 10 trades that you can take before you lose all the money. So if you want to protect the money and walk away with it at the end of the week, that is what you got to do. It's not about the technicals or the next trade. It's about protecting downside risk and then also capital management, protecting upside risk. Said, howdy, Roy. Welcome back. I love trading with you, but you don't trade every day. Why? Because that's not how trading works. Trading is not show up to your job every day. Trading is, if I got shit to do and I have to force the trades, I'm not going to do it. That simple. Forex TV shorts. Lesson number 1. Not every day is a trading day. You can show up every day. You don't need to trade every day. So that's probably something that we'll get back to here with live streaming, but we got a lot of motion out here in real life, people. Latin America tour is about to get started. We're about to start doing massive prep for the FX Summit LATAM. So it's going to be a little bit busy, but I'm going to make time for these live streams. You guys know I like to get on here and chat shit, spit game. Catch you guys later. Happy and safe trading. Catch you on the next stream. Peace. Yo, my tabs are all over the place today, people. Take it easy, y'all. Catch you guys in the chats. This thing is gone. It's up, and